we are inviting Petri Kuusisto for the keynote speaking about money for purpose, how to draft a strategic asset allocation within sustainable investing. Hi,
Thank you.
Petri. Yeah,
Yes.
hi. Yes, I can see you now. Wonderful.
Good.
Yeah.
Good. Thank you for the privilege of being able to speak here at the summit. I have a background of 30 years of being more or less all my career as a chief investment officer, and there have been some observations I've been facing when doing some strategic asset allocations, sitting at different investment committees, and incorporating today some of the sustainability issues. We have come to a conclusion that sometimes it looks like that the key decision makers are not actually that active on deriving the strategic asset allocation, and hence we've come across to create a new theory, and I will show it in a minute. I will go through some slides of the presentation, and this is not only my work. This is a teamwork where 4 people have been participating. Mr. Korpela is a co-founder of Impact Innovation Institute, which we founded in January this year to be the channel to distribute our research, what we are creating. Mr. Kaivoja is a professor on future studies, and the Swedish professor, Mr. Fagerström, has been very vocal on sustainable accounting theory. And I'm going to cover this topic through the introduction of sustainable portfolio theory, which we have drafted and so far never presented. So this is the global release of our theory. Our working paper will be published in 1 or 2 weeks when the professors are happy with our work. But the background of all this thing is that investors need good information in order to make informed decisions on where to invest their capital. And as we know, all investing by nature is forward-looking, but our information systems tend to be a little bit backward-looking, or at best they are focused on the real time. And in order to incorporate the sustainability indicators, we've kind of ended up by creating this new theory. And we all know that businesses also create either positive or negative values through their activities, and sometimes the externalities the companies are creating are not incorporated into their balance sheets or profit and loss statements. But investments also create impacts, whether we want it or we don't want. And we wanted to start this theory as a new dimension against the old and familiar modern portfolio theory. So we are going through a new dimension about financing and investing, and actually Mr. Markowitz himself stated some 50 years ago that it is precisely at the point of where assumptions break down that financial models pushed to their limits lead to disastrous consequences. And hence we have felt that as the world is changing, sustainability investing is slowly but surely evolving into becoming a mainstream, that we actually need a new dimension of the good old modern portfolio theory. Here you can see the symbol of the Impact Innovation Institute. It's from the Vikings, as I am a Nordic person. This is called Vegvisir. It actually means that you are a pathfinder and kind of representing a Nordic compass, but we also see that it is a symbol of protection and guidance, which we hopefully can produce through this new theory. The sustainable portfolio theory, where it's deviating and where the main actionable items can be laid down in 3 layers. The efficient market theory starts that market is taking care of many things. We disagree with this thing, and the first thing within the sustainable portfolio theory, what the investors should be doing is defining what is the purpose of their money, what is their intent. What intent is, I will come back to that in a short moment. But the second founding layer of the theory is the choice of which information systems you are supposed to use. And the first, of course, is accounting. What we are used to looking at the accounting is kind of inside out, leaving out all the externalities. The second layer goes into the risk management, which tends to be a measure of quantifiable statistical numbers, which are leaving out the uncertainty. And for risk management, we need data, but for capturing out uncertainty, we need tools from the future studies. And the third layer of the theory is perhaps the most revolutionary one. We are very used within the investment of forecasting, looking at the near-term future quite often with the help of a rear mirror, and hence the forecast tend to be in the form of linear models. But to be able to capture uncertainty and to co-create the future, what the foresight analysis is able to demonstrate to us, we can show that actually investors can co-create and shape the future. And we will go these parts in the following few minutes. We are just positioning here that what is sustainable portfolio originally, and where the best fit is obviously within the impact investing. My personal view is that at least the early versions of the ESG investing won't live too long. I mean, it's I do consider that the connotations through the impact will outlive the early versions of the ESG. ESG is just simply not enough for today's world. Now, getting into the core of this presentation, intent is a new concept, and like I think yesterday's presentation, Ben was stating out that there is no simple one straightforward recipe how you can define the purpose of your money. I mean, some organizations can look at things through their mission. You can have value alignment. You can have visionary thoughts. Your culture may affect to what could be the intent of your portfolio. But intent in itself is a philosophical concept. It actually is stating out your consciousness or the character of your mind. It's about or about something. So it is not precise measure. And we can also be a little bit critical to simple measures, because there's also a Goodhart's law about unintended consequences, and the intent is more describing the direction or the preferred future. It is not exact measurable item. But the intent is clarifying with the mindset of why you invest. And then the latter parts of the presentation will describe of how to do it. And intent is very essential for this whole strategic asset allocation exercise, because investors set their priorities, or what they set as their priorities shall determine what they consciously care about. And like already earlier said, in the old days we used to think about investing only as the accumulation of the wealth, but whether we want it or didn't want, there is also an impact which is happening when we invest into new areas. And there's a lot also a theory of definition of intent. Interestingly enough, the one of our earlier publication is comparing Islamic finance into impact investing, and it seems that the Western world has much more narrow meaning of the word of intent. The Islamic culture is talking much more in deeper and longer description of the intent, and basically they not only connect the mind but also the heart into the definition of intent. Let's go forward to the information systems. One more word. I mean, the clear objective through the definition of intent is that this is how you get your investable universe. When you do this exercise, you are not just simply picking up the benchmarks which are available or what your wealth manager is proposing you to use so that they can manage their product, but here you define through your value alignment or culture or whatever component of your intent is important to you. You define which instruments are eligible and where you really want to invest and where you do not want to invest. So let's get into the information systems. The mission with the accounting has been that we've been focusing on the corporation, first looking at the department, booking the results from there, going into the firm level, and then more or less excluding all the externalities. And there's a lot of research going now at the Harvard University, led by Sir Ronald Cohen and George Serafeim, about the impact-weighted accounting, which is actually focusing on the product. But there has been much earlier attempts. Already 1950s, there was a researcher called Suojanen who was focusing on stakeholder theory and looking at how the employees of the company derive various type of stakeholder value. So it seems that the 30-40 years where the focus was simply purely on shareholder values, that the next move will incorporate stakeholder values in much better way. And this is actually, even though we know that the externalities have a lot of subjectivity into defining their values, but it's not completely new. If we look at, for example, what the IFRS has brought into defining the goodwill value, I would say that it's equally imprecise way of creating a number into your balance sheet. So we are talking about a new dimension into the modern portfolio theory, and one key component is that usually the traditional risk management falls short because it's more focusing on the strategy execution and less so on strategy formulation. Often the strategy formulation is more or less left untouched, which I already described earlier, where where do you want to invest, how you want to invest is not that much of discussed. Somebody is dropping the benchmarks, and there you go, 80% of your security selection is done. And then equally the similar approach is considered within the risk management, because you only look at the measures which are quantifiable, and then the uncertainty part is left untouched. And here we go and look at the uncertainty, which here is described as a positive source of generating alpha. And the authors of this theory have a strong belief that portfolios which are managed utilizing both the externalities, i.e. the sustainability indicators, and then incorporating uncertainty. Through that way, you can create a lot more resilient portfolio than the traditional way of creating portfolios. And here on the left side of the chart, you can see what is called looking at the uncertainties, and these are alternative scenarios which go let's say 20, 30 years forward, sometimes even 50, and from these alternative futures the investors can choose their preferred ones, and these preferred ones are the ones you can then choose to co-create with other investors, and these different colors are chosen to look at the pathways where you are supposed to backcast, go back from the pathways, trying to define the thinking, where the thinking is moving from the future, and trying to define what sort of actions we need to do today or in the near-term future. So this is completely different way than doing the traditional forecasting. And of course, here on the backcasting, the starting point is the stakeholder dialogue, and you need to be able to do that one in order to get the stakeholders engaged into the process. And this is quite huge difference when we think about the investors' mindset. I mean, sustainable investors will engage with a completely different mindset. when embracing collaboration over competition is already very different concept than the today's way of creating the strategic asset allocation. It's always for yourself or for your institution. Here, the completely different mindset starts from collaboration, that you go and co-create the future with other like-minded investors. And this is probably the biggest and most crucial difference, how we differ from the traditional modern portfolio theory. And before the time is running, this picture is meant to describe that, of course, we are not only creating a theory, we are also creating workshops and other tools how to do this in practice. This is one way to create your value alignment. But I'm more or less used 30-year experience and for people 2-year work in 20 minutes, and whoever is willing to get our working paper when we are able to release it, I'm happy to send it. And,
yeah, absolutely. Actually, there is one question from Andreas Harbig. He says, do I correctly understand that you are explicitly moving beyond the VAR perimeter, mapping terra incognita? Could
yes.
we start a conversation, please? And he gives his email address to connect.
Yes, please. Definitely, I mean, value at risk is not incorporating like I was describing here, the value at risk is usually trying to capture the tail. It can be fat, but it's not able to recognize, for example, quite often with these whenever there's a new sustainability in information incorporating into the values, the changes can be instantaneous, and there is no value at risk type of a calculation which can capture that one.
Okay.
So again, for the uncertainty, you need backcasting. Completely different tool than traditional forecasting.
And you were talking about the strategic asset allocation. What about tactical? Depending on the variation, you structure the portfolio again. Is that possible with this offer, with this theory?
Yes, of course. Of course, the intent is supposed to last against time. Mm-hmm. But looking at the future in a different way, I mean, this backcasting is actually rotating. So you should repeat this, and there are always weak signals coming before they can even be turned into scenarios. And of course, these weak signals should prompt us to rethink.
Okay. And one more question, because this is a bit my area as well. So I just wanted to know a bit on the asset allocation side. And I was also told about a year ago that a new accounting, a new way of thinking accounting, three-leg accounting, instead of the asset liabilities, there is also the other side, which is the cost, to the environment as a third leg. Is that related, or this is a completely different way of looking?
Well, we are saying that these non-financial items. Today's accounting theory is not incorporating them as a cost at all. But however, the accounting seems to be taking fast steps. I mean, all over the world, we are now seeing the increased demands for the disclosure. And once you have the disclosures, I mean, it's exactly the same thing as the goodwill related accounting. Somebody's pressing the button, and there you go. It's in the balance sheet. And I think the more forward-looking investors are completely capable of deriving the outcomes and conclusions from this.
And the theory is actually in practice, is like it's all tested and is working, is in a working status at the moment. It can be applied.
This is exactly where the tools are still under development, because we want to create a easy and applicable and even online available definition of intent, because I don't think nobody has really been thinking through the intent, because we haven't thought about the impacts within investing. Everybody has been focusing on the pure financial wealth accumulation, but there is more and more pressure coming from that. Hey, actually the money talks.
I mean, actually, in the definition of impact investing, there is the use of intent too. Investment intended to create a positive impact.
Exactly. You cannot be sure. It cannot be a straightforward goal, but it's an intent, which and a decision done today.
It's all new. This is a very exciting time, to be honest.
Yes.
And I'm looking at the Q&A. So Andreas, we will provide with his contact details, or maybe you see it already.
Yes, I see it.
Yeah, wonderful. And I mean, I have no other questions. It's wonderful to have you here, and then very interesting presentation, very futuristic, forward-looking, as you said, and hopefully we will keep in touch as well, because it's very interesting for me too.
Okay.
Thank you very much.
Thank you.
Thank you.
Bye.